Let's start by understanding a key concept in central banking, the bank rate. It's essentially the interest rate the Reserve Bank of India charges commercial banks for short-term loans. This rate influences how banks lend to their customers and, in turn, affects the broader economy. We'll explore how this rate fits into RBI's toolkit. Let's talk about the bank rate. This is the rate at which the Reserve Bank of India lends money to commercial banks for the long term. That means loans lasting more than a year. Another way to think about it is the rate at which the RBI rediscounts commercial bills. This is different from the repo rate, which deals with short-term lending. So, when we say bank rate, we're focusing on long-term support to banks. Let's look at the investment limits defined by the MSME Development Act of 2006 for service sector enterprises. The question focuses on what qualifies as a medium enterprise based on investment. The options range from as low as 10 lakh rupees up to 10 crore rupees, divided into different brackets. Understanding these categories helps us identify the scale of businesses and the support they might receive under the Act. For medium enterprises, the investment limit falls within a specific range that sets them apart from small and large businesses. Let's look at how the definition of medium service enterprises has changed. Under the older 2006 Act, these enterprises had investments between 5 crore and rupee 10 crore. Now, the definition has expanded significantly. Medium enterprises, whether in manufacturing or services, are defined by investments up to 50 crore and turnover up to 250 crore. This change reflects the growing scale and ambition of businesses today, allowing more companies to qualify as medium enterprises. Let's look at a key date in India's financial history. The question is, when was the Export-Import Bank of India established? We have 4 options here: January 1, 1949, April 1, 1935, July 12, 1982, and January 1, 1982. This bank plays a crucial role in supporting India's international trade, so knowing its founding date helps us understand the timeline of India's economic development. Keep these dates in mind as we explore further. Let's take a moment to understand the origins of the EXIM Bank. It was set up on January 1, 1982, as a top-level financial institution. Its main goal: to support exporters and importers with financial assistance and to boost international trade. The bank's headquarters are based in Mumbai, serving as the hub for its operations. This foundation laid the groundwork for facilitating global commerce and strengthening trade ties. Let's look at some tools the Reserve Bank of India uses to control credit flow. We have the bank rate, open market operations, and the statutory liquidity ratio. These are all quantitative methods, ways to directly influence the money supply. Now, the question is, which one here is not a quantitative credit control method? It's a chance to test our understanding of how RBI manages the economy through these levers. Let's talk about quantitative and qualitative controls in banking. Quantitative controls focus on the amount of money flowing through the system. Things like the bank rate, open market operations, the statutory liquidity ratio, and the cash reserve ratio. On the other hand, marginal requirement is a qualitative control. It's selective, designed to regulate how much a bank can lend against the value of collateral. This helps improve the quality of loans and manage risk. So, the right answer here is marginal requirement. Let's talk about who oversees mutual funds in India. There are several key players: the Ministry of Finance, IRDAI, SEBI, and RBI. But when it comes to mutual funds specifically, one regulator takes the lead. This question helps us pinpoint the authority responsible for ensuring mutual funds operate fairly and transparently in the Indian market. Understanding this is crucial for anyone involved in finance or investing in India. Let's talk about SEBI, the Securities and Exchange Board of India. Set up in 1988 and given legal authority in 1992, SEBI plays a crucial role in regulating mutual funds, capital markets, and stock exchanges. It acts as a platform, bringing together issuers, investors, and intermediaries to ensure the market runs smoothly and fairly. In this context, the correct answer is B, SEBI. Mezzanine capital is a unique form of funding in the world of venture capital. It's not the initial money you put in to start a business, nor is it just temporary cash while you wait for permanent equity. Instead, mezzanine capital steps in later, when a project begins generating profit but hasn't yet reached full efficiency. Think of it as long-term debt that bridges the gap, helping businesses grow steadily toward their full potential. Mezzanine capital comes into play when a project is already making money, but hasn't quite hit its full stride yet. It's that extra boost to help push things forward. This is different from seed capital, which is the very first funding to get a business off the ground. And bridge capital, that's short-term money, filling the gap until more permanent financing is locked in. So mezzanine capital supports growth at a crucial middle stage. Let's talk about the timeline for settling claims under the PM Fasal Bima Yojana after crop cutting experiments are done. The options range from within 1 month to within 6 months. Understanding this timeline is crucial because it sets expectations for farmers waiting for their claims. The question is, how quickly can the process be completed? Is it a matter of weeks or several months? This helps us gauge the efficiency of the system in providing timely support. When it comes to insurance claims in agriculture, timing is crucial. Claims must be settled within 2 months after the harvesting or crop cutting experiments are completed. That means the process moves quickly, ensuring farmers get their due compensation without unnecessary delays. There's also a 1-month notification period, a window to report any risks under the scheme. So the key takeaway here is that claims are settled within 2 months, keeping things efficient and fair for everyone involved. Let's look at India's future as a consumer market. According to the World Economic Forum, India is set to climb the ranks dramatically. By 2030, it won't just be a major player, it's expected to become the world's largest consumer market. This slide asks us to pinpoint exactly where India will stand. Will it be first, second, third, or fourth? The answer highlights the scale of opportunity and growth ahead. India is on track to become a global economic powerhouse. According to the World Economic Forum, by 2030, it will be the world's third-largest consumer market. That puts it right behind the US and China. This shift highlights the growing influence of India's population and economy on the global stage. It's a major milestone, one that will reshape markets and opportunities worldwide. Let's look at the question about which state led the NITI Aayog Index for performance on the UN Sustainable Development Goals. The options are Bihar, Tamil Nadu, Kerala, and Himachal Pradesh. This slide challenges us to think about which state has made the most progress toward these global goals, reflecting strong policy and sustainable development efforts. It's a key point in understanding regional leadership in sustainability within India. When we look at the NITI Aayog SDG Index, Kerala stands out as the top performer. It's ranked number 1, leading the way in sustainable development goals. Right behind it is Himachal Pradesh, also doing well. On the other end of the spectrum, Bihar is noted as one of the states facing the biggest challenges. So the clear answer here is Kerala, the state setting the standard for progress. Let's look at the nature of the Economic Advisory Council to the Prime Minister, or EACPM. It's not a constitutional body, so it doesn't have a permanent place in the Constitution. Instead, it's a non-constitutional, permanent, and independent body. That means it's set up to provide ongoing advice, but it's not created by law in the same way as some other institutions. This distinction helps us understand its role and authority within the government framework. Let's talk about the EACPM. It's a non-constitutional, independent body, meaning it's not established by the Constitution, but still operates with permanence. Its role is to advise the Prime Minister on key economic issues, like inflation, industrial output, and microfinance. This setup allows it to provide ongoing, unbiased advice without political interference. So, the right way to describe it is as a non-constitutional, permanent, and independent body. Let's talk about a key figure in agricultural history. The question here is, who is known as the father of the Green Revolution in India? This title is often given to someone whose work transformed food production and helped millions avoid hunger. Think about the people listed. Each played a role in agriculture, but one stands out for pioneering the changes that made Indian farming more productive and sustainable. We'll explore their contributions and why this title matters. When we talk about the Green Revolution, two names stand out. MS Swaminathan is known as the father of the Green Revolution in India. Globally, Norman Borlaug holds that title for his work in developing high-yield crops. And the term Green Revolution itself was coined by William Gaude. But for this question, the correct answer is MS Swaminathan, the key figure who transformed agriculture in India. This slide asks about the origins of NABARD, the National Bank for Agriculture and Rural Development. It lists 4 important committees and commissions in India's financial history. The question is, which one led to NABARD's creation? The options range from the Hilton Young Commission to the Narasimhan Committee, the B. Sivaraman Committee, and the R.V. Gupta Committee. Understanding these committees helps us trace how India's rural credit system evolved over time. NABARD, or the National Bank for Agriculture and Rural Development, came into being on July 12, 1982. Its creation was guided by the recommendations of a key committee, the B. Sivaraman Committee, also known as the CRAFICARD Committee. This committee laid the groundwork for NABARD's role in supporting agriculture and rural development across the country. Understanding this origin helps us see why NABARD is so central to rural finance today. Let's take a moment to think about the Reserve Bank of India, the country's central bank and monetary authority. The question here is simple. In which year was it established? We have 4 options: 1934, 1935, 1949, and 1955. Knowing the correct year helps us understand the historical context of India's financial system and how it evolved after independence. This is a key date in India's economic history. Let's look at the origins of the Reserve Bank of India. It was set up on April 1, 1935, following the RBI Act passed the year before. This marked a major step in India's financial system. Later, in 1949, the bank was nationalized, bringing it fully under government control. So, when asked about its establishment year, the correct answer is 1935. This date marks the beginning of the RBI's crucial role in India's economy. Let's look at some key financial rates: the cash reserve ratio, the statutory liquidity ratio, the repo rate, and the prime lending rate. 3 of these are set by the Reserve Bank of India, but one is. The question here is simple: which rate is not determined by the RBI? Understanding this helps us see how monetary policy influences the economy. Here, we're looking at how different interest rates are set. The Reserve Bank of India controls things like the cash reserve ratio, the statutory liquidity ratio, and the repo rate. But the prime lending rate, that's different. It's decided by each commercial bank on its own, based on their policies and the customers they serve. So, when we ask which rate is set by individual banks, the answer is the prime lending rate, or PLR. Let's look at a question about a significant book in India's economic history. The book, titled Planned Economy for India, was published in 1934. Who wrote it? The options include S.N. Agarwal, M. Visvesvaraya, Jawaharlal Nehru, and M.N. Roy. This question invites us to connect the author with the early ideas about planning India's economic future. It's a key moment in understanding how economic planning took shape in India. Let's talk about a key figure in India's economic history, M. Visvesvaraya. Back in 1934, he wrote a book called Planned Economy for India. This work wasn't just a book. It laid the groundwork for formal economic planning in the country. His ideas helped shape the way India approached development and growth, setting the stage for future strategies and policies. So, when we think about the origins of planned economy in India, Visvesvaraya's contribution stands out clearly. The main objective of the third 5-year plan focused on 4 key goals. First, rapid industrialization, pushing the economy to grow faster through new industries. Second, building a self-reliant and self-generating economy so the country could stand on its own feet. Third, the removal of poverty, tackling the root causes to improve living standards. And finally, growth with stability, making sure progress was steady and sustainable, not just quick bursts. These goals shaped the plan's overall direction. The third 5-year plan, running from 1961 to 1966, set out with a bold goal to build a self-reliant and self-generating economy. But things didn't go as planned. Conflicts with China and Pakistan, along with severe droughts, hit the country hard. These challenges turned what was meant to be a period of growth into what many call the worst plan in that era. It's a reminder of how external factors can deeply impact economic strategies. Here, we're looking at a key part of the gross national product formula. The question asks what the letter M stands for in GNP equals GDP plus X minus M. M represents imports, the value of goods and services brought into the country from abroad. This matters because when calculating national income, we subtract imports to avoid counting spending on foreign products as part of domestic production. It's a crucial piece in understanding how trade flows affect the overall economy. Let's take a closer look at what M represents in the national income identity. Here, M stands for imports, but more precisely, it's the income earned by foreign nationals within the country that flows out. So, when we talk about M, we're really focusing on the money leaving the economy because of foreign income. This helps us understand the full picture of how income moves across borders in national accounts. When the Reserve Bank of India follows a cheap money policy, it's all about making borrowing easier and cheaper. This usually means lowering interest rates to encourage businesses and individuals to invest and spend more. The goal is to boost economic growth by increasing liquidity in the market. It's the opposite of tightening. Instead of controlling inflation by raising rates, the RBI aims to stimulate activity by reducing the cost of money. This policy can also influence other factors like credit growth and liquidity in the system. Let's talk about a cheap money policy, also known as an expansionary policy. This approach lowers key interest rates, like the bank rate and repo rate. By doing this, it makes borrowing cheaper, encouraging businesses and individuals to invest more. The goal is to boost the flow of money in the economy, sparking growth and activity. So the right answer here is B. It reduces interest rates to encourage investment and growth. Let's talk about the Blue Revolution in India. This term refers to a major boost in fish production. It's all about increasing aquaculture and fisheries to meet growing demand. So, when you hear Blue Revolution, think fish, not milk, fertilizers, or oilseeds. This revolution transformed India's seafood industry, making it a key player in global fish production. Let's talk about the Blue Revolution. This movement focuses on boosting fish production, making it a key part of food security. You'll see different colors representing different sectors. Green stands for agriculture like wheat and rice, yellow is for oilseeds, and white represents milk. But here, blue is all about fish. So when you see the question, the answer is clear. It's fish that the Blue Revolution is all about. Let's look at different types of taxes in India and figure out which one is a direct tax. We have GST, customs duty, excise duty, and wealth tax. Some taxes are direct, paid straight by the individual or organization, while others are indirect, passed on through goods or services. Among these options, only one fits the direct tax category. Keep this in mind as we move forward. Let's take a moment to clarify the difference between direct and indirect taxes. Direct taxes are paid straight by the person or entity they're levied on. Think income tax, wealth tax, or corporation tax. On the other hand, indirect taxes like GST, customs, and excise are collected through intermediaries, often included in the price of goods or services. In this case, the correct answer is wealth tax, which is a direct tax paid by the individual or organization it applies to. Here we're looking at a question about two important international agreements, TRIPS and TRIMS. Both of these are linked to global trade and intellectual property rules. The question asks which organization they belong to. The options include the IMF, World Bank, WTO, and ADB. The correct answer here is the WTO, the World Trade Organization, which oversees these agreements as part of its role in regulating international trade. Now, let's talk about two important agreements under the World Trade Organization, TRIPS and TRIMS. TRIPS deals with intellectual property rights, making sure creators and innovators get fair protection worldwide. TRIMS, on the other hand, focuses on investment measures related to trade. Both play a crucial role in shaping global trade rules. So, when asked which organization oversees these agreements, the answer is the WTO. Let's look at the different parts of the World Bank Group. We've got the IBRD, IDA, IFC, and MIGA. Each plays a unique role in supporting development projects around the world. Now, the question here is, which one is called the soft loan window? It's the part that offers loans with more flexible terms, aimed at helping countries that need financial support but on gentler conditions. We'll explore that answer next. The International Development Association, or IDA, offers interest-free loans to its member countries. Because these loans come without interest, the IDA is often called the soft loan window. This makes financing more accessible for nations that need support but can't afford traditional loans. It's a crucial part of how the global community helps promote development and reduce poverty around the world. Let's look at a question about India's financial institutions. It asks which body is known as the mother of all central banks in India. The options include the State Bank of India, SEBI, RBI, and NABARD. The key here is understanding the role and history of these organizations, especially the Reserve Bank of India, which is often called the central bank's central bank. This question helps us appreciate the foundation of India's banking system. Let's talk about the Reserve Bank of India, or RBI. It's the top bank in the country, the one that oversees all the others. It manages the currency, controls credit, and keeps the financial system stable. Because of these crucial roles, it's known as the apex bank. So, when asked which bank holds this position, the answer is clear: it's the RBI. Let's take a moment to focus on the RESIDEX index. This index is all about tracking changes in a specific sector. The options here range from the stock market to mutual funds, housing prices, and agricultural commodities. RESIDEX actually relates to housing prices. It measures trends in real estate values, giving us insight into the property market's movements over time. Understanding this helps us connect economic indicators with everyday life, especially when it comes to buying or selling homes. Today, we're looking at RESIDEX, India's first official housing price index. It was introduced by the National Housing Bank, or NHB, to track how housing prices change over time. This index gives us a clear, reliable way to understand trends in the real estate market. So when we talk about RESIDEX, we're really talking about housing prices, how they rise, fall, and what that means for buyers and sellers alike. A closed economy is one where there's no interaction with other countries through trade. That means no imports, no exports, just everything produced and consumed within the country. So, it's not about the government stepping back or taking a hands-off approach. Instead, it's about having no trading at all. The key idea here is that a closed economy operates completely independently from the global market. Let's talk about what a closed economy really means. It's an economy that doesn't trade with other countries, no imports, no exports. It stays completely isolated from international markets. So, when we say a closed economy, we mean it operates entirely on its own, without any exchange of goods or services beyond its borders. This idea helps us understand how economies can be structured differently depending on their openness to trade. When the Reserve Bank of India wants to control credit, it uses different tools. Some are quantitative, like the cash reserve ratio or statutory liquidity ratio. These directly influence the amount of money banks can lend. But there's also a qualitative tool called moral suasion. This isn't about numbers or rules. It's more about persuasion, guidance, and encouraging banks to act responsibly. So the qualitative tool here is moral suasion. It's the RBI's way of steering credit without changing the hard limits. Let's talk about moral suasion, a different kind of tool the RBI uses. Unlike quantitative measures like CRR, OMO, or SLR, moral suasion is more about persuasion. It's a selective, qualitative approach where the RBI encourages banks to follow certain guidelines without enforcing strict rules. It's less about numbers and more about influence. In this case, the answer is C, moral suasion. Let's take a moment to think about fiscal policy, the tools governments use to manage the economy. We know taxation, public expenditure, and credit rationing all play a role. But public debt, that's a bit different. It's not really an instrument to steer the economy directly. Instead, it's more a result of how those other tools are used. So, when we ask which one isn't an instrument of fiscal policy, public debt stands apart. Let's talk about fiscal policy and credit rationing. Fiscal policy deals with government revenue, like taxes, and how the government spends money. Credit rationing, on the other hand, is a tool used by the Reserve Bank of India. It controls the availability of credit in the economy. In this case, the correct answer is credit rationing, which falls under monetary policy, not fiscal. It's a key way the RBI manages economic activity. Let's look at the Integrated Rural Development Program, or IRDP. The question is, during which 5-year plan was it implemented? The options range from the 4th to the 7th plan. This helps us place the program in a specific time frame, understanding when key rural development efforts were officially launched. It's a way to connect policy initiatives to their historical context, showing how development strategies evolved over time. The Integrated Rural Development Program, or IRDP, was first introduced in 1978, but it wasn't until the 6th 5-year plan, starting in 1980, that it was fully put into action. This plan marked a major step in rural development, aiming to improve livelihoods through coordinated efforts. So, when we talk about IRDP's full implementation, it's the 6th plan that really brought it to life. Let's talk about the PURA model. That stands for Providing Urban Amenities to Rural Areas. It's a concept aimed at bridging the gap between rural and urban living standards. Now, this idea was proposed by one of 4 notable figures: P.V. Narasimha Rao, A.P.J. Abdul Kalam, M.S. Swaminathan, or Manmohan Singh. Each of these leaders has made significant contributions, but the PURA model is closely associated with one in particular. Today, we're looking at a visionary idea from Dr. A.P.J. Abdul Kalam. He proposed the PURA model, a plan to bring urban facilities right into rural villages. The goal? To reduce the flow of people leaving their homes for cities. By improving infrastructure and opportunities locally, PURA aims to create sustainable growth where it's needed most. This approach helps balance development and keeps communities thriving without the pressure of urban migration. Let's look at female literacy rates in India according to the 2011 census. The numbers here show different options, but the correct figure is 65.46%. That means just over 6 out of 10 women were literate at that time. It's a crucial statistic reflecting progress, but also highlighting the work still needed to achieve full literacy for all women across the country. Let's look at literacy rates from the 2011 census. Overall, about 74% of the population could read and write, but when we break it down by gender, the numbers tell a different story. Male literacy was higher, at just over 82%. Female literacy lagged behind, at around 65.5%. This gap highlights ongoing challenges in education access and equality. The correct answer here is 65.46%, the female literacy rate. When we talk about national income in India, there are a few key terms to keep straight. It can be calculated as GDP at market price, which is the total value of goods and services produced. Then there's GNP at market price, which adds income from abroad. NNP at factor cost subtracts depreciation and adjusts for taxes and subsidies. Finally, NNP at market price is another way to measure it. Understanding these options helps us see how national income is framed and measured. National income is a key economic measure. It's defined as the net national product at factor cost. In simple terms, it represents the total income earned by all factors of production, like labor and capital within a country. This helps us understand the real earnings generated by the economy, after accounting for depreciation and indirect taxes. So, when we talk about national income, we're referring to option C, net national product at factor cost. India's mixed economy is a unique blend that brings together different sectors to work in harmony. It combines agriculture and industry, the backbone of production and growth. It balances domestic and foreign trade, opening doors to both local markets and global opportunities. It merges public and private sectors, blending government oversight with private enterprise. And it bridges rural and urban sectors, ensuring development reaches every corner of the country. This combination shapes India's economic landscape. A mixed economy combines the best of both worlds, private ownership and government control. It's not just one or the other. Instead, it blends capitalism's drive with socialism's oversight. This means both the public and private sectors play important roles, working together to shape the economy. So, when we talk about a mixed economy, we're really talking about this balance, where businesses and the government each have their part to play. When we talk about the factors of production in economics, each one earns a specific type of reward. For land, the reward is called rent. It's the payment made for the use of natural resources. So, while wages reward labor, interest rewards capital, and profit rewards entrepreneurship, rent is what landowners receive for their contribution. Understanding these distinctions helps us see how income is distributed across the economy. Let's break down the 4 factors of production and what they earn. Land earns rent, that's the payment for using natural resources. Labor earns wages, which is the pay for work done. Capital earns interest, the return on investments. And entrepreneurship earns profit, the reward for taking risks and innovating. In this case, the correct answer is rent, since it's what land specifically earns. Let's talk about scheduled banks. These are banks that appear in a specific schedule of the Reserve Bank of India Act from 1934. The question is, which schedule lists these banks? Is it the first, second, third, or fourth schedule? Understanding this classification helps us see how the RBI regulates and supports different banks within the financial system. It's a key detail for grasping the structure of banking oversight in India. Scheduled banks are those listed in the second schedule of the Reserve Bank of India Act from 1934. To qualify, they need to have a minimum paid-up capital of 5 lakh rupees. This classification ensures certain standards and regulatory oversight. So, when we talk about scheduled banks, we're referring specifically to those included in the second schedule. The correct answer here is option B, second schedule. Let's take a look at the Reserve Bank of India's current inflation target. It's set at 4%, but with a band of plus or minus 2%. That means the RBI aims to keep inflation between 2 and 6%. This target helps guide monetary policy decisions, balancing growth and price stability. The other numbers on the slide show different rates, but the key figure here is that 4% target with its allowed range. It's a crucial benchmark for the economy. The Reserve Bank of India's Monetary Policy Committee aims to keep inflation at 4%, but there's some wiggle room. They allow it to fluctuate between 2 and 6%. This target range helps balance price stability with economic growth. So, the correct answer here is 4%, plus or minus 2%. It's a clear way to keep inflation in check without being too rigid. Let's look at the different systems under which currency notes can be issued. There's the proportional reserve system, where currency issuance depends directly on reserves held. Then the minimum reserve system, which sets a baseline amount of reserves. The fixed fiduciary system relies on a fixed amount of fiduciary media. And finally, the gold standard, where currency is backed by gold reserves. The question here is, which of these systems does India use to issue its currency notes? Since 1957, India has used the minimum reserve system to back its currency notes. This means the government must hold a minimum reserve of 200 crore rupees, split between 115 crore in gold and 85 crore in foreign currency. This system ensures there's always a solid base, supporting the money in circulation. It's a key part of how India manages trust and stability in its currency. The correct answer here is the minimum reserve system. Let's talk about oligopoly, a market structure that's defined by a few large sellers who depend on each other. It's not a single seller, like a monopoly, and it's not a market flooded with many small sellers. Instead, oligopoly sits in between, with just a handful of big players shaping the market together. This interdependence means their decisions often affect one another, creating a unique competitive environment. Oligopoly is a market structure where just a few large sellers hold most of the power. These sellers don't act in isolation. They're highly aware of each other's moves, especially when it comes to setting prices and deciding how much to produce. Because they're so interdependent, one company's decision can ripple through the whole market. So when we talk about oligopoly, we mean a few big players, closely watching and reacting to one another. Let's talk about what devaluation really means when it comes to currency. It's not just any drop in value. It can happen in a few ways. Sometimes, it's a deliberate move by the government to reduce the external value of their currency. Other times, it's more about inflation eating away at what your money can buy inside the country. It's important to understand these differences, because devaluation affects everything from prices to trade and the economy as a whole. Devaluation happens when a government intentionally lowers the value of its currency compared to others. The goal? To make exports cheaper and more attractive on the global market. This strategy can help boost a country's trade balance by encouraging foreign buyers to choose their goods. So, when we talk about devaluation, we're really talking about a deliberate drop in currency value set by the government. It's a powerful tool with big economic implications. When we talk about the balance of payment, or BOP, we're looking at a comprehensive record of a country's economic transactions with the rest of the world. It includes both visible trade, that's goods you can see and touch, and invisible trade, like services, investments, and transfers. So, the BOP isn't just about exports and imports of physical products, but also the flow of money from services and other financial activities. It's a full picture of a nation's economic exchange, beyond just government aid. The balance of payments, or BOP, is like a detailed ledger for a country's financial interactions with the world. It tracks every transaction, whether it's goods we can see, like cars or food, or invisible services, like tourism and banking. So, when we talk about BOP, we're looking at both visible and invisible trade combined. This gives us a full picture of how money flows in and out of a country. When we talk about measuring economic development, several indicators come into play. GDP, or gross domestic product, is often the starting point. It shows the total value of goods and services produced within a country. GNP adds income from abroad. Per capita income breaks that down per person. But the question is, which one really captures economic development best? This slide challenges us to think critically about these measures and what they reveal about a nation's progress. When we talk about measuring a country's development, GDP tells us about overall economic performance, but it doesn't show how that wealth is shared among people. That's where per capita income comes in. It divides the national income by the population, giving us the average income per person. This makes it a much better indicator of the standard of living and, ultimately, development. So the best answer here is per capita income. Let's look at what the second five-year plan focused on. It prioritized agriculture first, because a strong agricultural base was essential. Then came heavy industries and rapid industrialization, aiming to build the backbone of a modern economy. Poverty alleviation was also a key goal, addressing the needs of the most vulnerable. Finally, education played a role, laying the foundation for long-term growth and development. These priorities shaped the plan's approach to transforming the economy. Let's look at the second plan, running from 1956 to 1961. It was built on the Mahalanobis model, which aimed to create a strong industrial foundation. The focus was clear: heavy industries and rapid industrialization. This plan wasn't about quick fixes or consumer goods. Instead, it prioritized building the backbone of the economy, investing in steel, machinery, and infrastructure to fuel long-term growth. This approach shaped the country's industrial landscape for decades to come. Let's look at four major iron and steel plants: Bhilai, Rourkela, Durgapur, and Bokaro. Now, the question is, which one was established with help from Britain? It's a key detail in understanding how international partnerships shaped industrial growth. Keep these names in mind as we explore the origins and collaborations behind India's steel industry. The answer lies in recognizing the plant linked to British assistance. During India's second five-year plan, several industrial cities were developed with international support. Durgapur was built with help from the United Kingdom. Bhilai received assistance from the Soviet Union. and Rurkella was developed with support from West Germany. So, when we look at this question, the correct answer is Durgapur, the city associated with UK collaboration during that period. Let's take a moment to think about the Kisan Credit Card, or KCC, scheme. It's a crucial initiative aimed at supporting farmers with easy access to credit. Now, the question is, when was it launched? Was it in 1991, 1998, 2005, or 2015? Knowing the right year helps us understand how long this support system has been in place for our farming community. Let's talk about the KCC scheme, a program designed to get credit to farmers quickly and efficiently. It was introduced in August 1998, following recommendations from the R.V. Gupta Committee. The goal was simple: provide timely financial support to farmers, helping them manage their needs better. So, when we look at the timeline, 1998 is the key year that marks the beginning of this important initiative. Thomas Malthus's theory on population suggests a crucial imbalance. He argued that population tends to grow geometrically, that is, it doubles over consistent periods, while food production grows only arithmetically, increasing by fixed amounts. This means population can outpace food supply, leading to shortages. Understanding this idea helps us see the challenges of sustaining growing populations over time. Thomas Malthus made a striking observation about growth. He said population tends to double 2, 4, 8, growing geometrically. Meanwhile, food production increases much more slowly, in a steady arithmetic way, 1, 2, 3. This mismatch, he warned, would eventually cause serious problems, as people outpace the resources they need to survive. So the key idea here is that population grows geometrically, while food grows arithmetically. Let's look at the ministries involved in this question. The National Nutrition Mission, or HI Abhiyan Anus, is a major initiative aimed at improving nutrition across the country. So which ministry takes the lead here? It's the Ministry of Health and Family Welfare. They're responsible for policies and programs that promote health and nutrition, making them the right fit for this mission. The other ministries play important roles too, but this one is at the forefront of the nutrition agenda. Let's talk about the Poshan Abhiyan, a major initiative launched in 2018 from Junjhunu. This program is overseen by the Ministry of Women and Child Development. Their role is crucial because this ministry focuses on improving the health and nutrition of women and children across the country. Understanding who leads such efforts helps us see how government priorities are organized and where accountability lies. So, when we think about Poshan Abhiyan, remember it's the Ministry of Women and Child Development that drives it forward. Let's look at the maximum loan amount available under the Taran category of the Mudra Yojana. This scheme supports young entrepreneurs, helping them start or expand their businesses. The options range from 50,000 rupees up to 1 crore. The question is, which of these amounts is the maximum loan one can get under this specific category? Understanding this helps us grasp the scale of financial support offered to emerging entrepreneurs. Under the Mudra scheme, the loan amounts vary depending on the stage of the business. For Shishu, loans go up to 50,000 rupees. Kishore loans increase that limit to 5 lakh rupees. And finally, Taran covers loans from 5 lakh up to 10 lakh rupees. So when we're asked about the maximum loan under Mudra, the answer is 10 lakh rupees. That's the upper limit for Taran loans. The Stand Up India scheme is designed to boost entrepreneurship, but it targets specific groups. It's not for everyone, but for those who face unique challenges in starting a business. The focus is on rural youth, ex-servicemen, and communities like scheduled castes, scheduled tribes, and women. By supporting these groups, the scheme helps create opportunities where they're needed most, encouraging new ventures and economic growth in underserved areas. Let's talk about Stand Up India, a program launched in 2016. Its goal is to support entrepreneurship by facilitating loans between 10 lakh and 1 crore rupees. What's unique is that each bank branch must provide these loans to at least one borrower from the scheduled castes or scheduled tribes, and at least one woman borrower. This initiative is all about empowering SC, SD, and women entrepreneurs, giving them better access to finance and opportunities. Mission Indradhanush is a government initiative focused on full immunization coverage. It aims to protect children and pregnant women from vaccine-preventable diseases. This program is about ensuring that no one misses out on essential vaccines, strengthening public health from the ground up. So, when we talk about Mission Indradhanush, we're really talking about building a healthier future through immunization. This mission focuses on protecting the most vulnerable, children under 2 and pregnant women, from 7 diseases that vaccines can prevent. The goal is clear: to achieve full immunization coverage for these groups. By doing this, we're not just preventing illness, but building a healthier future for families and communities. It's about making sure no one misses out on the protection they need, right when they need it most. Let's talk about the SWAYAM initiative. It's a government program designed to provide free and high-quality online education. This platform opens up learning opportunities for everyone, no matter where they are. It's not about pensions, financial aid, or LPG connections. It's about making education accessible and affordable through the internet. SWAYAM helps bridge gaps and empowers learners with knowledge at their fingertips. SWAYAM stands for Study Webs of Active Learning for Young Aspiring Minds. It's an initiative designed to bridge the digital divide for students across the country. The goal here is simple: to provide free, high-quality online education that anyone can access. This platform opens doors for learners who might otherwise face barriers, making education more inclusive and available to all. In short, SWAYAM is about leveling the playing field through digital learning. Let's look at who leads the Financial Stability and Development Council, or FSDC. The options include the RBI Governor, the Prime Minister, the Union Finance Minister, and the SEBI Chairman. The FSDC plays a crucial role in overseeing financial stability in the country. Understanding who chairs this council helps us grasp how financial policy and regulation are coordinated at the highest level. So, which one do you think it is? The Financial Stability and Development Council, or FSDC, was set up in 2010 as a top-level body. Its main role is to coordinate between various financial regulators across the country. At the helm of this council is the Union Finance Minister, who chairs the meetings and guides its decisions. This leadership ensures that financial policies stay aligned and effective across different sectors. So, the correct answer here is the Union Finance Minister. When we see the acronym CBS in banking, it can stand for a few different things. But most commonly, CBS means Core Banking Solution. This is the technology that lets banks process transactions and manage accounts in real time, across all their branches. It's the backbone of modern banking operations. Other options like central banking system or credit bureau services are important too, but they're different parts of the financial ecosystem. Here, CBS points us to the core system that keeps banking running smoothly. Let's talk about CBS. That stands for Core Banking Solution. It's a network of bank branches linked together so customers can access their accounts from any branch, no matter where they originally opened it. This system makes banking flexible and convenient, breaking down the old barriers of location. With CBS, your bank is always just around the corner, wherever you go. Let's talk about the Global Gender Gap Index, a key measure used to track gender equality around the world. This index is released by the World Economic Forum, or WEF for short. The WEF brings together leaders from business, government, and civil society to improve the state of the world. Their gender gap report highlights where progress is being made and where work still needs to be done. It's a powerful tool for understanding global gender disparities. The World Economic Forum, or WEF, puts together this index by looking at 4 key areas. First, economic participation, how involved people are in the workforce. Then educational attainment, the levels of education achieved. Health comes next, covering well-being and life expectancy. Finally, political empowerment, the extent to which people can influence decision-making. These 4 dimensions come together to give a clear picture of gender equality worldwide. Let's look at the ATL Innovation Mission, or AIM. It's a key initiative designed to foster innovation and entrepreneurship across India. Now, the question is, which organization is AIM set up under? Is it the Ministry of Science and Technology, the Ministry of Skill Development, NITI Aayog, or CSIR. Understanding this helps us see where innovation policy is being driven from in the government. The answer points us to the central hub for strategic planning and innovation. Today, we're looking at AIM, the ATL Innovation Mission. This is a flagship initiative by NITI Aayog, aimed at sparking a culture of innovation and entrepreneurship across India. One of its key efforts is setting up ATL tinkering labs, where young minds get hands-on experience with new ideas and technologies. So, when asked who leads this initiative, the answer is clear. It's NITI Aayog driving this exciting movement forward. Let's look at what happens when marginal utility hits zero. Marginal utility measures the extra satisfaction from consuming one more unit of something. When it's zero, that means adding more doesn't increase total satisfaction at all. So, total utility reaches its maximum point. It stops growing and levels off. This concept helps us understand how people decide when to stop consuming a product or service. It's a key idea in economics that explains consumer behavior. Let's talk about the law of diminishing marginal utility. As we consume more of something, the extra satisfaction we get from each additional unit starts to drop. Eventually, we reach a point where consuming more doesn't add any satisfaction at all. That's when marginal utility hits zero. At this exact moment, our total satisfaction is at its highest. So the answer here is maximum satisfaction. A liquidity trap happens when people stop spending or investing, even though interest rates are very low. Instead, they prefer to hold onto cash. Sometimes, this can be worsened by government actions like freezing bank accounts or a shortage of physical currency in the market. The key idea is that, despite cheap borrowing costs, the economy stalls because confidence is missing and money just sits idle. Let's talk about what happens in a liquidity trap. Even when the RBI lowers interest rates, people don't respond the way we'd expect. Instead of borrowing or investing, they hold on to cash. Why? Because they either expect rates to rise later or feel uncertain about the future. So, despite cheap money, demand doesn't pick up. The key point here is that people prefer cash over investment, making low rates ineffective in boosting the economy. Open market operations are all about buying and selling in the financial markets. Specifically, they involve transactions in government securities, things like bonds issued by the government. These operations help control the money supply and influence interest rates. So, while you might think of stocks, gold, or foreign currency, it's really government securities at the heart of open market operations. This tool is key for managing the economy's flow of money. Let's talk about OMO, or open market operations. This is when the Reserve Bank of India buys or sells government securities on behalf of the government. The goal? To control the money supply in the economy. By buying securities, RBI pumps money in. By selling, it pulls money out. This tool helps keep inflation and growth in balance. So the key instrument here is government securities. Let's talk about priority sector lending, or PSL, for domestic commercial banks. This is a key requirement designed to ensure banks lend to sectors that need it most, like agriculture, small businesses, and housing. The mandatory percentage for PSL is actually 40%. That means banks must allocate at least this portion of their lending to these priority sectors, supporting inclusive growth and economic balance. It's a crucial part of how the banking system supports the broader economy. Banks are required to direct 40% of their total lending to specific sectors. This includes agriculture, which takes up 18%, along with micro, small, and medium enterprises, and other weaker sections of society. This rule ensures that credit reaches parts of the economy that need it most, supporting growth and inclusion. So the correct answer here is 40%. Let's take a closer look at some economic scenarios. We have options like low inflation paired with low unemployment, or high inflation alongside high unemployment and low growth. There's also low growth with low inflation, and high growth with low inflation. Now, the question is, what exactly is stagflation? It's a tricky situation where inflation is high, but growth is low, and unemployment is also high. This combination makes it especially challenging for policymakers to address. Stagflation is a tricky economic situation. It happens when inflation stays high, but growth is barely moving, and unemployment is also high. This combination is unusual because inflation and unemployment don't usually rise together. So, when we talk about stagflation, we mean a period marked by rising prices, sluggish economic activity, and more people out of work. It's a tough spot for policymakers to manage. The correct answer here is high inflation with high unemployment and low growth. Let's talk about where the law of diminishing returns applies. It's not limited to just one sector. It affects all sectors of production, agriculture, industry, mining, you name it. This law shows up whenever adding more input leads to smaller and smaller increases in output. So whether it's farming, manufacturing, or extracting resources, the principle holds true across the board. It's a fundamental concept that helps us understand efficiency in any productive activity. Let's talk about a key idea in production. When you increase one factor, like labor or capital, while keeping everything else the same, the extra output you get starts to shrink. This is known as diminishing returns. It's not limited to just one area, it applies across all sectors of production. So, no matter the industry, pushing one input harder without adjusting others will eventually yield smaller gains. This principle helps us understand efficiency and limits in production systems. When we want to compare how people live around the world, we need a way to measure their economic well-being fairly. That's where purchasing power parity, or PPP, comes in. PPP helps us compare things like literacy levels, crime rates, global poverty, and standards of living by adjusting for differences in local prices. This way, we get a clearer picture of what money can actually buy in different countries, making comparisons more meaningful and accurate. Let's talk about purchasing power parity, or PPP. It's a way to compare the value of different currencies by looking at the price of the same basket of goods, like a Big Mac, across countries. This helps us understand real differences in global poverty and standards of living, beyond just exchange rates. By using PPP, we get a clearer picture of how far money actually goes in different places around the world. Let's break down what defines a monopoly market. It's a market where there's only one seller, just a single provider controlling the entire supply of a product or service. No competition, no alternatives. That's what sets a monopoly apart from other market types, where you might have two sellers, unlimited sellers, or even none at all. Understanding this helps us see how market power and pricing get shaped. In a monopoly, the market is controlled by just one supplier. This single seller has exclusive control over a product that has no close substitutes. Because of this, they can set prices without worrying about competition. It's a unique situation where the usual rules of supply and demand don't apply in the same way. The monopoly holds all the power. The correct answer here is B, a single seller. Let's talk about taxes in India, focusing on which one is considered progressive. Out of GST, sales tax, income tax, and customs duty, the progressive tax is income tax. That means as your income rises, the tax rate increases too. It's designed to ensure those who earn more contribute a fairer share, balancing the system. The others, GST, sales tax, and customs duty, don't follow this pattern. So, when we say progressive tax, we're really talking about income tax in the Indian context. Let's talk about progressive taxes. These are designed to increase as your income goes up, meaning those who earn more pay a higher rate. This system helps to reduce economic inequality by shifting the tax burden based on ability to pay. In this case, the tax we're focusing on is income tax. It's the classic example of a progressive tax that adjusts with your earnings. This approach aims to create a fairer distribution of wealth across society. Let's look at the top players in India's IT software export scene. We have Infosys, Wipro, TCS, and HCL, all giants in their own right. But when it comes to consistently leading the pack as the highest software exporter, one company stands out. This question challenges us to identify which of these has maintained that top spot over time. It's a key insight into India's global tech footprint. Tata Consultancy Services, or TCS, has consistently led the pack when it comes to export revenue from software and services. For several years now, they've held the top spot, showcasing their strength and reach in the global market. This slide highlights that achievement, pointing out TCS as the clear leader in this space. It's a testament to their scale, expertise, and the trust they've built worldwide. Let's look at the thinkers behind the innovation theory of profit. This theory explores how profits arise from innovation, new ideas, new methods, new products. Among the options, Adam Smith laid the groundwork for economics, but it was J.A. Schumpeter who really developed this theory. He saw entrepreneurs as the drivers of economic change, making profit through innovation. So the answer here is Schumpeter. Joseph Schumpeter made a key observation about how entrepreneurs make profit. He said it's by bringing new products or technologies into the market, creating something fresh that changes the game. This idea highlights the role of innovation in business success. So, when we think about who first explained this, the answer is J.A. Schumpeter. He's the one who connected entrepreneurship directly to innovation and profit. When we talk about the father of economics, we're referring to the thinker who laid the foundation for modern economic theory. Among the names listed, one stands out as the pioneer who first shaped economics as a formal discipline. This question invites us to consider the origins of economic thought and the figures who influenced how we understand markets, value, and wealth today. Let's see who is widely recognized with this title. Let's talk about Adam Smith, the man often called the founder of modern economics. He wrote The Wealth of Nations back in 1776, a book that changed how we think about markets, trade, and wealth. When we consider the origins of economic theory, Adam Smith's ideas are the foundation. So if you're asked who started it all, the answer is clear. It's Adam Smith. Let's talk about disguised unemployment, a concept where more people are working than actually needed, but it's not obvious at first glance. In India, this is most common in the agriculture sector. That's where many people are involved, but productivity per worker is often low. It's a hidden challenge because it looks like everyone has a job, but the output doesn't match the number of workers. This slide helps us pinpoint where this issue is most prevalent. Let's talk about a situation where having more workers doesn't actually add any value. This happens when the extra labor's productivity drops to zero. Basically, too many people are working, but no extra output is gained. In our example, this issue is most common in the agriculture sector. It's a classic case of diminishing returns, where adding more hands just doesn't move the needle anymore. Let's talk about hot money. It usually refers to short-term capital flows that move quickly in and out of markets, chasing the best returns. Among the options here, it's most closely tied to foreign portfolio investment, or FPI, because this type of investment is more liquid and can be withdrawn rapidly. That's what makes it hot. It's money on the move, not tied down like long-term foreign direct investment or domestic savings. Understanding this helps us see how financial markets react to global shifts. Let's talk about what's known as hot money. This term refers to foreign portfolio investment, or FPI. It's called hot money because it moves fast. Investors can pull their money out of a country's stock market at the first hint of trouble. This makes FPI highly volatile, and it can have a big impact on financial markets. So when you hear hot money, think of money that's quick to come and quick to go. Let's talk about the Gini coefficient. It's a number that tells us about income inequality, how evenly or unevenly wealth is spread across a population. It doesn't measure unemployment, inflation, or the poverty line directly. Instead, it focuses on the gap between the richest and the poorest. A higher Gini means more inequality, while a lower one suggests a fairer distribution of income. Understanding this helps us grasp the bigger picture of economic fairness. Let's talk about the Gini coefficient and the Lorentz curve. These tools help us understand how income or wealth is spread across a population. They give us a clear picture of inequality, showing whether resources are shared evenly or concentrated among a few. In this case, the key idea is income inequality. That's what these measures are all about, revealing the gaps between different groups in society. Let's take a closer look at the four main sectors that make up India's economy. We start with the primary sector, agriculture, where raw materials come from the land. Then, the secondary sector, industry and manufacturing, where those materials get transformed. Next is the tertiary sector, services, which includes everything from banking to education. Finally, mining, a key part of the primary sector but often considered separately. Now, the big question. Which of these sectors contributes the most to India's GDP? Let's focus on the service sector. It's the biggest driver of India's economy. When we talk about the largest contributor to GDP and national income, it's the tertiary sector, also known as the service sector. This includes everything from banking and education to healthcare and tourism. It's where most economic activity happens, shaping livelihoods and growth across the country. So the correct answer here is C, the tertiary or service sector. Let's talk about deficit financing. What does it really mean? It's when a government covers a budget shortfall not by cutting spending or raising taxes, but by borrowing money or printing new currency. Instead of balancing the books right away, the government chooses to finance the gap through debt or money creation. This approach can help stimulate the economy, but also comes with risks, like inflation or growing debt burdens. Understanding this concept is key to grasping how governments manage their finances in tough times. When a government spends more than it earns, it needs to find a way to cover that gap. This is called deficit financing. Often, this means borrowing money or even printing new currency through the central bank. While this can solve immediate budget shortfalls, it comes with a risk: inflation. Too much money chasing too few goods can push prices up, affecting the entire economy. So, deficit financing is a balancing act, with consequences that need careful management. Let's look at what the Pradhan Mantri Ujjwala Yojana offers. This initiative focuses on providing free LPG connections to households below the poverty line. It's a targeted effort to improve energy access and reduce reliance on traditional fuels. While other programs might focus on electricity or solar lamps, this one is all about clean cooking fuel, making a real difference in health and convenience for millions of families. Let's talk about a program launched in 2016 that made a real difference. It provides clean cooking fuel, specifically LPG, to women from underprivileged backgrounds. The goal here is simple: to give free LPG connections to households below the poverty line. This initiative not only improves health by reducing smoke from traditional fuels, but also empowers women by easing their daily chores. It's a practical step toward cleaner, safer homes for those who need it most. The main goal of the 12th Five-Year Plan is to achieve fast and more inclusive growth. It aims to accelerate economic progress while making sure the benefits reach everyone. This means focusing on faster, sustainable, and more inclusive growth. Alongside that, the plan targets the removal of poverty and promoting self-reliance. Finally, it supports rapid industrialization as a key driver for overall development. Together, these objectives shape a balanced and ambitious roadmap for the future. Let's look at how the 12th Plan, covering 2012 to 2017, shifted its focus. It didn't just aim for faster growth anymore, it added sustainability to the mix. So, the goal became not only to grow quickly, but to do so in a way that's environmentally and socially responsible. Alongside this, inclusivity remained key. In short, the plan emphasized faster, sustainable, and more inclusive growth as its core objective. Here, we're looking at a question from the 1991 reforms, focusing on what the letter L represents. The options are legislation, localization, libel, and liberalization. Each of these terms carries weight in different contexts: laws being passed, adapting to local needs, protecting reputations, or opening up markets. Understanding which one fits the reforms helps us grasp the direction and priorities of that period. Let's consider what each might mean in this setting. The LPG reforms refer to three major changes in India's economy: liberalization, privatization, and globalization. These reforms were introduced by P.V. Narasimha Rao and Manmohan Singh in the early 1990s. Among these, liberalization is the key step that opened up the economy by reducing government control and restrictions. This shift allowed businesses to operate more freely and compete globally, setting the stage for rapid economic growth. Let's look at the rolling plan concept, a key idea in economic planning. The question here asks which government introduced it. The options are the Congress government, the Janata Party government, the BJP government, and the left front. Understanding when and why this concept came about helps us see how different administrations approached long-term development. It's a way to keep plans flexible, adjusting as conditions change, rather than sticking rigidly to a fixed blueprint. Let's talk about the rolling plan from 1978 to 1980. This plan came into play after the Janata Party government, led by Morarji Desai, decided to end the fifth five-year plan ahead of schedule. Instead of sticking to the traditional long-term plan, they introduced a more flexible approach, the rolling plan. This allowed for adjustments based on changing circumstances, marking a shift in how economic planning was handled during that period. Let's look at different market situations based on the number of buyers and sellers. When there are many buyers and many sellers, it's a competitive market. One buyer and one seller create a unique scenario called bilateral monopoly. This means both sides have significant power. Other cases include many buyers with one seller or one buyer with many sellers. Understanding these setups helps us see how market power and negotiation work in different environments. A bilateral monopoly happens when there's just one seller and one buyer in the market. Think of a trade union negotiating with a single large employer. Both sides hold all the power. It's a unique situation where neither can easily walk away, so the outcome depends heavily on negotiation. In this case, the answer is B, one buyer and one seller. Gresham's law is a classic economic principle that tells us how money behaves in the real world. It says that when two forms of money are in circulation, the bad money tends to drive out the good. In other words, people hoard the valuable currency and spend the less valuable one. This idea helps explain why certain types of money disappear from everyday use when alternatives exist. It's a key insight into how value and trust shape our economy. Gresham's law is a fascinating idea about money in circulation. It tells us that when two types of money exist together, people tend to hold on to the good money, the kind with higher value, and spend the bad money instead. In other words, bad money drives out good. This principle helps explain why certain currencies or coins disappear from everyday use when alternatives are available. It's a simple concept with a powerful impact on how money behaves. Let's talk about the statutory liquidity ratio, or SLR. This is a rule banks follow to keep a certain portion of their funds in safe, liquid forms. But what exactly counts? The options include foreign currency, shares in the stock market, liquid assets like cash, gold, and government securities, or only cash held with the Reserve Bank of India. Understanding where banks maintain their SLR helps us see how they balance safety with liquidity. Let's talk about the statutory liquidity ratio, or SLR. This is the portion of a bank's deposits that they're required to hold in liquid form. That means cash, gold, or government-approved securities. It's a safety measure, ensuring banks always have enough liquid assets on hand. In this case, the correct answer is liquid assets like cash, gold, and government securities kept with the bank itself. This keeps the system stable and ready for withdrawals. Dumping in international trade happens when a product is sold in another country at a price lower than what it costs to produce. It's a way to gain market share by undercutting local competitors. This practice can disrupt markets and lead to trade disputes. So, when we talk about dumping, we're really looking at pricing that's below production cost, not just matching or exceeding domestic prices. Dumping happens when a country sells goods abroad for less than it costs to make them. The goal? To grab market share by undercutting competitors. This practice can hurt local industries, so countries respond with anti-dumping duties, tariffs designed to level the playing field. In short, dumping means pricing products below their production cost to gain an unfair advantage. Let's talk about the Lawrence curve. It's a tool we use to show how income is spread across a population. Specifically, it helps us understand income distribution, who's earning what, and how evenly or unevenly wealth is shared. This curve gives us a visual way to see economic inequality. So, when we hear about the Lawrence curve, we're really looking at the big picture of income distribution within a society. The Lawrence curve is a powerful visual tool. It shows us how wealth or income is spread across a population. Instead of just numbers, it gives us a curve that reveals inequality, who has more, who has less. In this case, the correct answer is income distribution. It's all about understanding how income is divided among people, highlighting gaps and disparities we might otherwise miss. Let's talk about the concept of invisible items in the balance of payments, or BOP. These aren't physical goods crossing borders. Instead, they refer to services, income, and transfers. For example, exporting software services fits this category perfectly. It's a service, not a tangible product. On the other hand, importing steel or exporting tea involves physical goods, which are considered visible items. So, when we think about invisible items, we're focusing on those intangible exchanges like software services. Let's clarify the difference between visible and invisible items in trade. Visible items are physical goods you can touch, like merchandise. Invisible items, on the other hand, are services, things like banking, shipping, or IT support. In this case, the correct answer is the export of software services, which falls under invisible items. It's a key part of modern trade, even though you can't hold it in your hand. Let's look at the key date when NITI Aayog was formed. There are 4 options here: August 15, 2014, January 1, 2015, April 1, 2015, and January 26, 2015. Understanding the exact formation date helps us place NITI Aayog in the right historical and policy context. It's important because this marks a shift in how planning and development strategies are approached in India. Keep these dates in mind as we explore its role further. Let's take a moment to understand a key shift in India's policy landscape. On January 1, 2015, the Planning Commission was replaced by NITI Aayog. This new body was created to serve as the government's premier policy think tank, focused on fostering cooperative federalism and driving sustainable development. It marked a fresh approach to planning and strategy, moving away from centralized planning to a more dynamic, inclusive model. Let's talk about the leadership of NITI Aayog. The question here is, who serves as the ex officio chairman of this important policy think tank? The options include the Vice President, the Prime Minister, the Finance Minister, and the President of India. Understanding this role helps us see who guides the strategic direction of NITI Aayog and influences its policy decisions at the highest level. Here, we see a key fact about NITI Aayog's leadership. The Prime Minister of India always serves as its chairman. This means the highest executive authority directly guides the Commission's vision and strategy. It's a unique setup that ensures alignment between the government's priorities and NITI Aayog's policy initiatives. So, the correct answer here is the Prime Minister, the central figure leading this important institution. Let's talk about giffen goods, a curious exception in economics. Normally, demand falls as prices rise. But with giffen goods, demand actually rises when prices go up. That means people buy more as things get more expensive. It's a rare case where the usual rules don't apply. So when we ask how demand behaves for giffen goods, the answer is clear: it rises as price rises. Let's talk about giffen goods, a curious exception in economics. These are a special kind of inferior good where something unusual happens. Normally, when prices go up, people buy less. But with giffen goods, the opposite occurs. The income effect is so strong it outweighs the substitution effect, meaning people actually consume more as the price rises. So the correct answer here is B, consumption rises as the price rises. It's a rare but fascinating phenomenon. Let's take a closer look at the GDP deflator, what it really measures. It's a ratio, comparing 2 key economic figures. Specifically, it's the relationship between nominal GDP and real GDP. Nominal GDP reflects current prices, while real GDP adjusts for inflation. So the GDP deflator helps us understand how much of the change in GDP is due to price changes, rather than actual growth in output. It's a crucial tool for separating inflation, effects from real economic progress. Let's talk about the GDP deflator. It's a way to measure overall price changes across all new, domestically produced goods and services in an economy. We calculate it by dividing nominal GDP by real GDP, then multiplying by 100. This ratio helps us understand how much prices have changed, separating pure growth from inflation. So, When asked which ratio defines the GDP deflator, the answer is nominal GDP to real GDP. It's a key tool for tracking economic health. Let's talk about a key economic principle called laissez-faire. This phrase means let do or let go, and it's all about minimal government interference in business. Of the four main economic systems, socialist, mixed, capitalist, and command, laissez-faire is closely tied to the capitalist economy. It champions free markets and individual entrepreneurship. So when you hear laissez-faire, think of capitalism and the idea that markets work best when left largely to their own devices. Laissez-faire, a French term meaning leave alone, describes an economic system where the government steps back and lets the free market operate on its own. There's minimal interference, allowing supply and demand to find their natural balance. This hands-off approach is a hallmark of a capitalist economy, where private individuals and businesses drive economic activity with little regulation. So, when you hear laissez-faire, think capitalist economy. Let's look at the committees that have shaped financial reforms over time. Among them, the Narasimhan Committee, R.V. Gupta Committee, Kelkar Committee, and Chalaya Committee each played distinct roles. But when it comes to the recommendation of the Kisan Credit Card, a vital initiative to support farmers, it was the R.V. Gupta Committee that put this idea forward. This card has since become a key tool in agricultural finance. Let's take a moment to understand where the Kisan Credit Card scheme came from. Back in 1998, the R.V. Gupta Committee recommended this initiative. Their goal was simple: to make credit flow easier and faster for farmers. By streamlining the process, they aimed to support agriculture more effectively. So, when we talk about the origins of the KCC scheme, it's the R.V. Gupta Committee that set the foundation. Let's talk about the Physical Quality of Life Index, or PQLI. It was created to measure well-being in a way that goes beyond just economic numbers. The index focuses on three key indicators: life expectancy, infant mortality, and basic literacy. These give us a clearer picture of how people are actually living, their health, education, and survival, rather than just looking at income or GDP. It's a more human-centered way to understand quality of life. The Physical Quality of Life Index, or PQLI, was developed by Morris D. Morris to measure well-being beyond just income. It looks at three key indicators: life expectancy, infant mortality, and basic literacy. These factors give us a clearer picture of quality of life, scored on a scale from 0 to 100. It's a way to understand how people are really living, not just how much money they make. Let's talk about the Phillips curve, a key concept in economics. It shows the relationship between inflation and unemployment. Essentially, it suggests that when unemployment is low, inflation tends to rise, and when unemployment is high, inflation usually falls. This inverse relationship helps policymakers understand the trade-offs they face when managing the economy. So, the Phillips curve connects two crucial economic indicators: inflation and unemployment. The Phillips curve shows us an important economic relationship. It suggests that when unemployment goes down, inflation tends to go up, and vice versa. In other words, inflation and unemployment move in opposite directions. This idea helps us understand the trade-offs policymakers face when trying to balance a healthy economy. So, the key takeaway here is the connection between inflation and unemployment. Let's look at different types of business arrangements that shape industries. We have trusts, cartels, holding companies, and cooperatives. Each plays a unique role in how companies work together, or sometimes compete. Today's example is OPEC, the Organization of the Petroleum Exporting Countries. It's a classic case of one of these structures, where member countries coordinate to influence oil markets. Understanding which type it fits helps us see how global industries organize and operate. OPEC is a classic example of a cartel. Member countries work together, agreeing to limit how much oil they produce. This coordinated effort helps them control supply on the global market. By doing this, they can influence prices and boost their collective profits. It's not just competition, it's cooperation with a clear goal: maximizing gains for all members involved. Indifference curve analysis helps us understand consumer choices. It shows different combinations of two goods that provide the same level of satisfaction or happiness to a person. This means the consumer doesn't prefer one combination over another. They're equally satisfied. It's a way to map out preferences and trade-offs, helping us see how people make decisions when faced with limited resources. An indifference curve shows us all the different combinations of two goods that provide the same level of satisfaction to a consumer. No matter which point you pick on that curve, the consumer feels equally happy. It's a way to visualize choices where preferences stay constant, helping us understand decision-making when trade-offs are involved. Here, the correct answer is different combinations of two goods that give equal satisfaction. Let's talk about the MGNREGA scheme and the guaranteed wage employment it promises. The question here is, how many days of work does it guarantee to each household? The options range from 50 to 200 days. The correct answer is 100 days. This means every eligible family is assured at least 100 days of paid work in a year, helping to provide economic security and support rural livelihoods. It's a crucial part of social protection in many communities. This slide highlights a key promise of the Act. It guarantees 100 days of unskilled manual work each year to every rural household that volunteers for it. That means if adults in the household step forward, they're entitled to this work opportunity. It's a way to ensure steady income and support for rural communities. The answer here is 100 days, a clear, measurable commitment that forms the backbone of the initiative. Let's talk about who's responsible for preparing the national income estimates in India. This is a key question because understanding national income helps us grasp the overall economic health of the country. The options include the Reserve Bank of India, the Finance Commission, NITI Aayog, and the Central Statistical Organization. Among these, the Central Statistical Organization, or CSO, is the body that actually compiles and releases the national income data. It plays a crucial role in economic planning and policy making. Let's talk about the Central Statistical Organization, or CSO. It operates under the Ministry of Statistics and Program Implementation. This agency is the key player when it comes to calculating India's national income and GDP. In other words, the CSO is the nodal agency responsible for these crucial economic numbers. Understanding this helps us see who's behind the data that shapes economic policy and planning in India. Let's take a moment to clarify the term service sector. It's another name for the tertiary sector, the part of the economy focused on providing services rather than goods. This includes everything from healthcare and education to retail and entertainment. It's different from the primary sector, which deals with raw materials, the secondary sector, which involves manufacturing, and the quaternary sector, which covers knowledge-based services. Understanding these sectors helps us see how economies are structured and evolve over time. Now let's talk about the tertiary sector. This part of the economy covers services rather than physical goods. Think banking, transport, education, things you can't hold, but that keeps society moving. When we're asked which sector these activities belong to, the answer is clear. It's the tertiary sector. It's all about providing services that support our daily lives and the economy as a whole. When we talk about direct action by the RBI, we're referring to the specific steps the Reserve Bank takes to enforce its policies. This might include penalizing or even closing bank branches that don't follow RBI directives. It's about direct intervention to ensure compliance, rather than broader market moves like increasing the repo rate or selling gold. The focus here is on immediate, targeted measures to keep the banking system in line. Direct action is about the Reserve Bank stepping in when banks don't follow the rules. It's a qualitative measure, meaning it's based on judgment, not just numbers. When banks fail to comply with RBI directives, the RBI can take legal or administrative steps. This might include penalizing the bank or even closing branches that don't meet the standards. It's a way to enforce discipline and ensure the banking system stays strong and trustworthy. Let's talk about the Statutory Liquidity Ratio, or SLR. This is a regulation that requires banks to maintain a certain percentage of their net demand and time liabilities in specific types of assets. These assets aren't just any investments, they're liquid and safe. The options include physical cash, liquid assets like cash equivalents, government securities, real estate holdings, or corporate bonds. Understanding which of these qualifies for SLR is key to grasping how banks stay financially stable. Banks are required to keep a certain portion of their net demand and time liabilities in liquid assets. This ensures they have enough ready cash or easily convertible assets to handle any sudden cash needs. These liquid assets include things like cash itself, gold, and government-approved securities. It's a crucial safeguard, making sure banks stay stable and can meet emergencies without hesitation. Let's take a moment to clarify what an indirect tax is. Unlike direct taxes, which are paid straight to the government by individuals or companies, indirect taxes are collected through intermediaries. For example, customs duty is charged on goods as they cross borders, making it an indirect tax. So, among these options, customs duty fits the bill as an indirect tax. It's a subtle but important distinction in how taxes impact the economy. Customs duty is a type of indirect tax. It's charged on goods when they're imported or exported. What makes it indirect is that the cost can be passed along, usually to the final consumer. So, while the government collects the tax at the border, the price impact often shows up at the checkout. In this case, the correct answer is customs duty. The Human Development Index, or HDI, is a composite measure that combines several key factors to give us a fuller picture of development. It looks at income, unemployment, and inflation, the basics of economic health. It also considers health, education, and standard of living, which reflect how people actually live and thrive. Beyond that, it includes literacy, sanitation, and housing, essential for quality of life. And finally, it takes into account export, import, and foreign direct investment, which show how connected a country is to the global economy. Together, these elements paint a broad, meaningful picture of human development. The Human Development Index, or HDI, is a tool created by the UNDP to track long-term progress in human development. It focuses on three key areas: health, education, and standard of living, which is measured by income. These dimensions together give us a clearer picture of how people's lives are improving beyond just economic growth. Understanding HDI helps us see where development is working and where it still needs to go. Let's take a moment to look at the 1991 economic crisis in India. It's often described through several lenses: food crisis, balance of payments crisis, population crisis, and housing crisis. But the primary issue at the heart of it was the balance of payments crisis. This was the key challenge that triggered major economic reforms and reshaped the country's financial landscape. Understanding this helps us see why those reforms were so urgent and necessary. In 1991, India was in the middle of a severe balance of payments crisis. The country's foreign exchange reserves had dwindled so low, they could barely cover 2 weeks of imports. This urgent situation forced India to rethink its economic policies. The result was the LPG reforms, liberalization, privatization, and globalization, which marked a major turning point in the country's economic history. This crisis wasn't just a challenge, it was the catalyst for change. When countries face a balance of payments crisis, meaning they can't pay for essential imports or meet international debt obligations, they often turn to specialized institutions for help. Among the options here, the International Monetary Fund, or IMF, is the key player. The IMF provides loans specifically designed to stabilize economies during such crises, helping countries get back on track. So, when we talk about support for balance of payments problems, the IMF is the institution that steps in. The International Monetary Fund, or IMF, plays a crucial role in the global economy. Its main focus is on fostering international monetary cooperation. When countries face balance of payments problems, meaning they can't meet their financial obligations, the IMF steps in with short-term financial assistance. This support helps stabilize economies and restore confidence. So, when we talk about global financial safety nets, the IMF is often the first institution that comes to mind. Let's look at who makes up NITI Aayog's governing council. This group includes the Prime Minister, along with chief ministers from all the states, and the lieutenant governors of union territories. It's a broad and inclusive team, bringing together key leaders from across the country to guide policy and development efforts. This council plays a crucial role in shaping the direction of NITI Aayog's work. To wrap up, the Governing Council is the top decision-making body of NITI Aayog. It embodies the idea of cooperative federalism, bringing together the Prime Minister, all the chief ministers, and the lieutenant governors of union territories. This council ensures that diverse voices shape our nation's development.